Inflation continues to reflect the push and pull of opposing forces. Overall weakness in the economy continues to pull inflation down. But price pressures in shelter and some other services are holding inflation up. Since the July NPR, the upward forces coming from prices for shelter and some other services have eased slightly. At the same time, the downward pressure coming from excess supply in the economy remains. If inflation continues to ease broadly in line with our July forecast, it is reasonable to expect further cuts in our policy interest rate. We will continue to assess the opposing forces on inflation and take our monetary policy decisions one at a time. Aujourd'hui, on a réduit le taux directeur de 25 points de base à 4,25%. C'est une troisième baisse consécutive depuis juin. Notre décision repose sur deux grandes considérations. Pour commencer, l'inflation globale et l'inflation fondamentale ont continué de baisser comme prévu. Ensuite, avec l'inflation qui continue de se rapprocher de la cible, il faut que la croissance économique s'accélère pour s'absorber l'offre excédentaire. C'est important pour que l'inflation retourne à 2% et y reste. L'inflation reflète encore des forces opposées. D'un côté, elle continue d'être poussée à la baisse par la faiblesse générale de l'économie. De l'autre côté, les pressions sur les frais de logement et les prix d'autres services nuisent à sa diminution. Mais ces pressions se sont légèrement modérées depuis juillet. En même temps, l'offre excédentaire demeure une source de pression à la baisse. Si l'inflation continue de ralentir généralement comme dans notre prévision de juillet, il est raisonnable de s'attendre à d'autres réductions du taux directeur. On va continuer d'évaluer les forces opposées qui agissent sur l'inflation et de prendre nos décisions de politique monétaire une à la fois. So let me expand on what we're seeing in the economy and how that played into our deliberations. In the second quarter, the economy grew by 2.1%, led by government spending and business investment. This was slightly stronger than we forecast in July. Together with first quarter growth of 1.8%, this suggests the economy grew by about 2% over the first half of 2024. That's a healthy rebound from the near zero growth we had in the second half of 2023. Our July projection has growth strengthening further in the second half of this year. Recent indicators suggest there is some downside risk to this pickup. In particular, preliminary indicators suggest that economic activity was soft through June and July, and employment growth has stalled in recent months. The unemployment rate has risen over the last year to 6.4% in June and July. The rise is concentrated in youth and newcomers to Canada who are finding it more difficult to get a job. Business layoffs remain moderate, but hiring has been weak. The slack in the labor market is expected to slow wage growth, which remains elevated relative to productivity. Turning to price pressures, CPI inflation eased further to 2.5% in July, and our preferred measures of core inflation also moved lower. With the share of CPI components growing above 3% now around its historical norm, there is little evidence of broad-based price pressures. But shelter price inflation is still too high. It remains the biggest contributor to overall inflation, despite some early signs of easing. Inflation also remains elevated in some other services. As outlined in our July forecast, inflation is expected to ease further in the months ahead. It may bump up later in the year as base year effects unwind, and there is a risk that upward forces on inflation could be stronger than expected. At the same time, with inflation getting closer to the target, we need to increasingly guard against the risk that the economy is too weak and inflation falls too much. On est déterminé à ramener l'inflation à la cible de 2% et on veut qu'elle y reste. On ne veut pas qu'elle soit supérieure ou inférieure à cette cible, car l'économie fonctionne bien quand l'inflation est autour de 2 %. En conclusion, dans un contexte où les pressions inflationnistes généralisées continuent de s'atténuer, le conseil de direction a décidé d'abaisser de nouveau le taux directeur de 25 points de base. L'offre excédentaire maintient les pressions à la baisse sur l'inflation. En même temps, les hausses des frais de logement et des prix d'autres services nuisent à la baisse de l'inflation. Le conseil de direction évalue avec soin ces forces opposées qui s'exercent sur l'inflation. Les décisions de politique monétaire seront guidées par les nouvelles informations que nous recevrons et notre évaluation de leurs implications pour les perspectives d'inflation. La Banque reste déterminée à rétablir la stabilité des prix pour les Canadiennes et les Canadiens. We are determined to get inflation down to the 2% target, and we want it to stay there. We care as much about inflation being below the target as we do above. The economy functions well when inflation is close to 2%. Let me conclude. With continued easing in broad inflationary pressures, Governing Council decided to reduce the policy interest rate by a further 25 basis points. Excess supply in the economy continues to put downward pressure on inflation, while price increases in shelter and some other services are holding inflation up. Governing Council is carefully assessing these opposing forces on inflation. Monetary policy decisions will be guided by incoming information and our assessment of their implications for the outlook for inflation. The bank remains resolute in its commitment to restoring price stability for Canadians. And with that, the Senior Deputy Governor and I will be pleased to take your questions. Thank you.
Okay, thank you, Governor. Let me just remind everyone of the ground rules, please. I've got a list of reporters, about a dozen here in Ottawa at the bank, as well as a handful on the line. So I'm going to start here in the room. I'll ask you to please limit yourself to one question so we can get through every media outlet. If I forget to do so, please state your name and affiliation. For the folks who are new this time, please press the green button in front of you to activate your microphone when asking a question, then shut it off. Once more, to shut it off, just press it again. Avant de poser une question, veuillez vous identifier si je ne l'ai pas fait. Et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's start with our first question here in Ottawa. I'm going to go to Najut Amaliz of the Canadian Press.
Good morning, Governor. I'm wondering if anybody around the table argued for a half-point rate cut, or whether that was something that you debated.
There was a strong consensus for a 25 basis point reduction in our policy rate. As I highlighted in the opening statement, this is our third consecutive policy rate. And the council also agreed that, as I mentioned, if inflation continued to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy interest rate. We also agreed we're not on a predetermined path. We're taking our decisions one at a time. We will be evaluating incoming information, and our decisions will reflect the best available information we have. We did discuss looking forward, we did discuss some different scenarios where it might be appropriate to slow the pace of declines in interest rates. We also discussed scenarios where it could be appropriate to cut by 50 basis points. So you're going to get the summary of deliberations in a couple of weeks, but to give you a couple of examples, if those upward forces in inflation prove to be stronger than we expected, if there's significantly less slack in the economy than we assess, yes, it might be appropriate to slow the pace of declines. On the other hand, if the economy was significantly weaker, if inflationary pressures, if the downward pressure on inflation was significantly weaker than we expected, yes, it could be appropriate to take a bigger step, something bigger than 25 basis points. But I'll come back to where I started. We're going to be taking the decisions one at a time. We will be assessing the data, and we will take our decisions based on the data we have.
Okay, next we'll go to Pramit Mukherjee from Thomson Reuters.
Yeah, thank you, Paul. Governor, just building on Najud's question, I mean, I want to ask that you are way above the neutral rate. Unemployment is very high. It's like 30-month high. Inflation is a 40-month low. At this stage, why 25 and why not 50? I mean, what is stopping you from being aggressive?
We started cutting in June. This is our third consecutive decrease. Inflation is still above our target. We still need to get inflation down to 2%. It's 2.5. We do expect in the coming months it will ease further. Against that background, we think a third cut in interest rates is appropriate. We do expect. If you look at our July forecast, we are expecting some pickup in growth, as we highlighted in my opening remarks and in the press release. The very recent data, the preliminary indicators suggest some softness through July and June. So there is some downside risk to that pickup, and that was another reason another factor that weighed on our decision and our decision to cut a further 25 basis points. And getting back to what I just said to Najud, we will be assessing the data as it comes out, and if we need to take a bigger step, we're prepared to take a bigger step. At this point, 25 basis points looked appropriate.
Okay, maintenant Olivier Ferrand-Boissé du réseau TVA.
Bonjour, merci à vous deux de prendre nos questions. Monsieur Macklem, quand vous écrivez qu'il est raisonnable de s'attendre à d'autres réductions de taux si l'inflation maintient les prévisions, avez-vous en tête un retour vers des taux neutres ou le conseil de direction maintient que la politique monétaire doit demeurer restrictive encore à court terme malgré l'affaiblissement de l'économie?
Le taux neutre, c'est un concept théorique. C'est quelque chose qu'on devrait mettre dans notre modèle. Mais c'est important de souligner, qu'est-ce que c'est le taux neutre? C'est le taux approprié quand l'inflation est proche de sa cible de 2%, l'économie fonctionne près de son pleine capacité, et il n'y a pas de choc. Donc, dans un sens, c'est quelque chose qui va jamais arriver. Ils vont toujours avoir des nouveaux chocs. Ils vont toujours avoir des nouveaux enjeux dans l'économie. Et c'est le taux directeur qui doit ajuster pour maintenir l'inflation près de la cible de 2%. Donc, oui, le taux neutre, c'est un concept important dans notre modèle. On devrait mettre quelque chose dans le modèle et on publie nos estimations en esprit de transparence. Mais ce n'est pas quelque chose qui pèse vraiment sur notre décision réunion à réunion. Donc, quand on dit que oui, c'est raisonnable d'attendre encore des réductions de taux directeur si inflation évolue généralement comme prévu, ça ne veut pas dire que nous sommes sur une route à neutre. C'est quelque chose plus à court terme. Et comme j'ai souligné, on va prendre nos décisions une à la fois.
Okay, let's go now to Mackenzie Gray from Global, please.
Hi there. Since we've last seen you, the federal government's announced reductions in the number of temporary foreign workers who are able to come to Canada. Governor, I'm hoping you can just comment on what you think big picture that will look like. And Deputy Governor, the Liberals have also signaled that there could be larger reductions in the overall number of immigration, particularly permanent residency. What would that have as a broader impact on the Canadian economy, specifically with housing?
Yeah, I mean, this is a number we're watching closely. The surge in population has had a big effect on the Canadian economy. In the early rise in inflation and when we saw a lot of pressure in the labor market, it helped. It took some of that pressure off the labor market. It added supply. It took some of the sort of steam out of the labor market and then gradually out of inflation. Where we're at now is the Canadian economy is at a point where it's having trouble absorbing the number of workers into the job rate. So, we haven't seen a big increase in unemployment, but we have seen vacancies come down, and we are seeing the unemployment rate tick up a bit. So it will be important that sort of influx of labor supply starts to sort of match our ability to absorb it. So, it's as we highlighted this in box 3 in our July NPR, the significant effect of population on the economy and on inflation. So it's something we're watching closely. The government has announced a target that they intend to hit, and they've announced a series of measures. We expect they'll announce a few more. We need a bit more detail to understand how they're going to go from that target. What is the execution path to get to that target? But because of the significant effect that it's having on the economy right now, it's something we're watching really closely.
Okay, let's go to Matt Lundy from the Globe and Mail, please.
Thanks for taking my question. Since the July announcement, the Fed has teed up a rate cut in a couple weeks' time. How does that factor into the bank's decision-making, and does this effectively get rid of concerns on policy divergence?
Well, the first point, and I always start with this point, we take monetary policy decisions in Canada in the best interests of Canadians. We have our own inflation target, we have a flexible exchange rate, so interest rates between Canada and the United States can diverge. As I've said before, yes, there are limits on how much they can diverge, but those limits have not become a constraint on Canadian monetary policy. If you look at policy over the last period, the policy rate in Canada did not go quite as high as it did in the United States. We've now cut our policy rate at 3 consecutive meetings by 75 basis points. The U.S. has yet to cut. So that divergence has widened. As you highlighted, markets are now expecting that the Fed will begin easing, and so that divergence doesn't look like it's getting bigger, and we're not seeing a big impact on our exchange rate. So, certainly the divergence has not run up against any limits to this point, and with markets now expecting the Fed to be easing, I don't expect it's going to come into play.
Okay, let's go to Paul Vieira from the Wall Street Journal, please.
Governor, are you at all concerned about the composition of GDP growth of late, especially in the second quarter, where basically all the heavy lifting was done by government spending, and there seemed to be a sharp drop-off in household consumption?
Well, Paul, in any one quarter, you often see the composition of growth shifting around. If you take the first 2 quarters of the year, what did you see? As I indicated, growth in the first 2 quarters averaged around 2%. That compares to roughly 0 in the last 2 quarters of the previous year. So we have seen good pickup in growth. If you look at what drove that growth, well, in the first quarter, actually, consumption was pretty solid. It picked up pretty sharply. Yes, you're right. In the second quarter, consumption growth slowed. It was more government and business investment. If you take the first 2 quarters as a whole, what you're seeing is, yes, some pickup in consumption, some pickup in business investment, and strong government spending. What are we looking for going forward? To get back to the previous question, the government has announced a series of measures to reduce the inflow of non-permanent residents. So population growth should start to come down. And population growth has obviously been adding consumers. It's been adding demand to the economy. What we are expecting is that you're going to start to see some pickup in per capita consumption. So individual household consumption is going to gradually ease. Lowering interest rates is going to encourage that. It's going to help that. That is something we're going to be watching for. We do want to see growth growth has strengthened in the first half of the year. We want to see it strengthen further. Going forward, we've got enough slack in the economy to get inflation back to target. We need to start taking up that slack, which means we need growth to be above potential output. We need to be growth above 2%. So as we move through the year, we are going to be looking for growth to further pick up, and you know that need for more growth going forward was something that factored into our policy decision.
Okay, we'll go to Randy Thantong-Knight from Bloomberg, please.
Can you give us an update on where you see the steady-state level of settlement balances for the payment system, given the ongoing maintenance in overnight markets to keep core closer to target? Has the bank changed its views on the level of reserve?
Yeah, we can give you an update, Randy, that we don't see much change in the target we have for settlement balances. I think we're hovering around 100 million still, and we still think we'll get somewhere closer to, we've given a range, but somewhere below 80. So we've got a ways to go. The pressure that we've seen in the overnight market, we don't see that as related to the level of settlement balances. I gave you a bit of an update at the July press conference on this, and since then we published a really good, really technical, but really good explanation that our staff have done on where we think the source of that pressure in the overnight market is, and why, specifically why we don't see it as related to our quantitative tightening or to our reduction in the overall settlement balances in the market.
Okay, let's go to Kevin Carmichael of The Logic, please.
Good morning. Governor, does the Bank of Canada still see the risk to the inflation outlook as balanced? The upper pressures are starting to look a little less evident than the downward ones. So could you just elaborate on how you're looking at that balance right now?
Well, if you go back to our July forecast, the inflation has come in broadly in line with that forecast, and when we put that forecast out, we viewed that forecast to be broadly balanced. What have we seen since then? Since we put the July forecast, well, as I said, inflation, core inflation have come down broadly in line with that forecast. That has, we're starting to see, shelter inflation is still much too high. But it looks like it is starting to roll over. It is starting to come down. That's something, to get back to the inflation target, we're going to see some easing in shelter price inflation. So that is something we're looking to continue. On the growth side, as I indicated, our July forecast has growth strengthening further in the second half of the year. The second quarter GDP growth actually came in a little bit stronger than we projected. We had 1.5, and the monetary policy report came in at 2.1. However, if you look at the monthly dynamic of that, it is softening into the summer. So there could be some downside risk to our GDP forecast in the near term. I mean, that is something we will be watching. So look, we'll have a new forecast in about 6 or 7 weeks in October, and it'll incorporate the data we've had so far as well as the new information we're going to get.
Okay, Jordan Gowling from Post Media, please.
Yeah, sort of in the same vein, you said today that upward pressures on inflation could be stronger than expected. Can you just expand on what those concerns are, apart from the base year effects unwinding at the end of this year?
Yeah, I mean, just to expand on that in general terms. So, first of all, in the months ahead, we do expect to see inflation continue to ease. Should get pretty close to the 2% target. It may, as you get in late in the year, early in next year, as those base year effects wear off, it could back up. What could get in the way? Well, as I indicated, if we saw we need to see some easing in shelter price inflation. I mean, shelter is like 25% of the average Canadian consumer's spending basket. It's a big part of what Canadians spend their money on, and it's running over 8%. So it's going to be very hard to get to 2% inflation when a quarter of your basket, a necessity, is running that high. So we're going to need to see some further easing. That, it is, there is a risk that shelter price inflation doesn't ease or even strengthens. We're not predicting that. That's not our base case. But when you're talking about risks, what could hold inflation up? That's certainly something that could hold it up. I mean, the other element I would raise is, there's always some uncertainty about how much slack there is in the economy. We do our best estimates. We look at a lot of indicators. We certainly think there is slack in the Canadian economy, but it is possible that there's less slack than we think, and particularly if growth were to strengthen more than we think, we could relatively quickly end up with much less, significantly less slack. So those are some of the upside risks. I mean, on the downside, though, I do want to highlight, particularly as inflation gets closer to the target, we have to guard increasingly against the risk that the economy is too weak. Inflation goes below our target. We don't want to hit the target and go right through it. We want to get back to 2, and then we want to keep inflation close to 2%. And as I've highlighted, we do need to see, we do want to see growth pick up so that when we get to 2% inflation stays close to the target. So those are the two things we're really trying to balance.
The other thing, Jordan, maybe I'll just add is we've got a close eye on the relationship between productivity and wages. Wages are still running ahead of productivity. We don't see a lot of evidence that that's feeding directly through to inflation pressure right now, but it's something we need to keep an eye on. So.
Okay, we're just about done here in Ottawa, but I'm going to call on Greg Quinn from Market News to go next.
Good morning. I wanted to ask about the mention of the risk that inflation can fall too far. Do you subscribe to any kind of ideas around whether, even with a symmetrical inflation target, small deviations below 2% can be overlooked a bit, or is it something that you really have to fight hard against?
Well, what I would stress is, look, we are, whether we're above the target or whether we're below the target, we're focused on getting inflation back close to 2%. We have a 1 to 3 band, and what is the how should people think about the band? Well, I think the band is really designed to give Canadians an indication. What is a normal variation in inflation? I mean, we're not literally going to hit 2% every month or every quarter. The economy is always evolving. There's always new price shocks, price discounts. Inflation's going to move around. The band is to give Canadians an idea of what is the normal variation. And if you look at least from 1995 until COVID hit, inflation was within that band about 80% of the time. So most of the time, inflation is between 1 and 3. But we're always aiming to get it close to the middle. If you want to be in the band most of the time, you got to be always taking action to try to get inflation close to the middle. So, yes, if we're a little over, we're a little under. We're going to be trying to get it back closer to 2%, and we are symmetric in that respect.
Okay, our last question here in the room goes to Mike Lukacher of CTV.
I think we're on there. Yeah, thanks for taking our questions. I just wanted to ask you something. You say you're taking monetary policy decisions one at a time, but at the same time, you've noted that it's reasonable to expect further cuts at the next meeting. How worried are you about sending a signal to Canadians about taking on too much debt as they see the interest rate start to drop?
Well, really now you're getting more into sort of financial stability issues. I mean, the reality is household debt in Canada is quite high. And, that's one reason why when households hold more debt, interest rates have a bigger impact. When we increased our interest rates, it has had a very material impact on many Canadians. I mean, they are feeling the squeeze from higher interest rates. And you can see it in the data. You can see it when you survey Canadians, you can see it when you talk to Canadians, and you can see it in how Canadians are behaving. They are, on a per capita, per household basis, they have cut back their consumption. That is not pleasant, it's difficult, but it has been important to take the steam out of inflation. That has worked. Inflation has come down. We're getting close to the target. And that's been reflected in our decisions to lower interest rates. That will reduce some of the pressure. I mean, if you've got a variable rate mortgage, you're already seeing some relief in terms of your monthly payments. If you're renewing your mortgage, obviously lower interest rate, you're still going to have a positive reset if you took your mortgage out when interest rates were at extremely low levels, but it won't be as big. Canadians are adjusting to that. Certainly some Canadians are, without question, finding it very difficult. With inflation coming down, it's time to start lowering interest rates and taking some of that pressure out.
Okay, we're going to go to the phones now. I'm just going to remind the people on the line, when I call on you, please come off mute only to ask your question and then go back on mute as soon as you've finished so everyone can hear the response. I've got 4 questioners on the line. We're going to start with BNN Bloomberg, please.
Good morning. With protectionism arising around things like EVs, steel, aluminum, and now seemingly canola between Canada and China, I'm wondering if you can give me a sense of where trade issues rank in terms of risks to your outlook. How concerned are you about recent events on the trade file specifically?
I'm not going to comment on sort of specific trade initiatives, but I can make a few general comments on trade. Look, there is no question the global trade landscape is changing. And that's going to impact the Canadian economy. And at the Bank of Canada, we need to understand how it's going to affect the economy, how it's going to affect cost pressures. I'm actually giving a speech next week in London, England. So I'll have a lot more to say about this, and there will be a press conference, so you can ask me some more questions after that. But I mean, very, very quickly, what are some of these big changes? Well, the pandemic has really highlighted the need to invest in the resilience, the robustness, the reliability of supply chains. That's needed, but it's going to have some costs. You can't only, if you're a business, it's not all about efficiency. It's partly about reliability as well. Geopolitical tensions have increased, and that is changing trade relationships, as you highlighted. There have been a number of trade actions taken. The U.S., Canada, many other countries have imposed restrictions on the import or export of high-tech goods to China. New tariffs on EVs. These things are impacting trade relationships. Economic security, even national security, is now having to factor into trade. That has potential consequences. Businesses need to think not just about the most efficient, the lowest cost production. They need to factor in issues around economic security. So, these things are. The global landscape is changing in trade. Canada's going to need to adapt to that, and. At the Bank of Canada, we are spending more time looking at, trying to understand how this could impact the Canadian economy and what this could mean for inflation and cost pressures. And as I said, I will have more to say about that next week.
Okay, thank you. We'll go now to Rob McClister from Mortgage Logic News. Go ahead, please, Rob.
Good morning. You mentioned that the bank doesn't expect shelter inflation to reaccelerate. I'm wondering over what time frame does that outlook refer to, given that falling rates typically do support real estate activity, and how much of a pickup in real estate prices would it take to worry the bank from a shelter inflation standpoint?
Yeah. Okay, well, let me clarify a little bit what I said there. When you look at shelter price inflation, it is a combination of a number of components. So it includes mortgage interest costs. It includes the costs that people are paying when they rent an apartment. It also includes the cost of fixing up your house, house maintenance, home insurance. All those things feed into the rate of the user cost of shelter. So the price of a house, price of new homes does factor into that through the cost of maintaining and fixing up your house. So yes, it wouldn't be surprising as interest rates come down, as activity in the housing market strengthens, you see some pickup in housing prices. We're not, we don't publish a detailed projection of housing prices, but that could well happen. But with mortgage rates coming down, hopefully with more supply coming into the rental market, with some reduction in population growth, you should see rent prices come down. So when I say, overall shelter price inflation can come down, I'm not saying that means house prices are coming down. House prices could well actually pick up a bit with overall inflation in shelter price still coming down.
Okay, we'll now go to Alicia Sikierska from Yahoo Finance.
Thank you for taking our questions. Governor, given some of the downside risks to the growth projections that you mentioned and the slack in the labor market, how is the central bank thinking about what you have previously called the narrow path to a soft landing scenario? Do you still see that as still in sight?
We're certainly a lot closer to landing than we were. I mean, inflation is much closer to the target than we were a year ago, and the economy, while it has certainly slowed, it hasn't weakened sharply, but we haven't landed the economy yet. The runway's in sight, but we have not landed it yet. And as I indicated, as we're getting closer to 2% target, we do have to guard more against the risk that the economy, inflation gets to be too weak. And that is factoring into our interest rate decisions.
And our last question is from Anna Pereira of the Toronto Star. Go ahead, please, Anna.
Hi, good morning. So we still have a fall fiscal update coming from the federal government this year. How will that impact your outlook for rate cuts by the end of the year?
Well, I don't know what's in the fall economic statement, so it's pretty hard to answer your question. Look, as a couple of general comments, as I've said many times before, we don't comment on fiscal policy. Fiscal policy is, our mandate is monetary policy. We are an independent central bank with a mandate to pursue 2% inflation. Fiscal policy is appropriately the purview of elected governments, parliamentarians, and I'm going to leave it to them. What do we do is, whatever the government, whatever they announce in their budgets, in their fall economic statements, we build those into our projections. We take them as given. I will just say that, when I do from time to time comment on fiscal policy, I do it from the perspective of what is the impact on inflation and what are the implications for monetary policy. Typically when the economy, when inflation's close to 2%, the economy's, operating, in the vicinity of its potential. Fiscal policy doesn't typically have major implications for inflation and monetary policy. Last year, inflation was well above target. The economy was clearly overheated. And against that background, I did express that further increases in government spending could make it more difficult to get back to the 2% in target. I will say that, today we're in a pretty different situation. Inflation's a lot closer to the target. The economy is in excess supply. And so I am not feeling the need to comment further on fiscal policy.
Okay, and that concludes today's press conference. Thanks to the Governor and Senior Deputy Governor. Thank you, all of you, for joining us. We'll see you again.